Hello, I'm Adam Grimes. This is being recorded for March 16th, 2020, and this is going out to both my Market Life folks and also my longer-term institutional advisory clients at Talent Advisors. So the first part of this video, let's look at the big picture and think about what the future might hold. This is a time of great uncertainty. Markets are emotional, people are emotional, and we're all under a lot of stress. So with that background, let's look at what's going on around the world. Let's just look at some monthly charts. I think this is kind of a big picture perspective that we lose many times when we focus on the day-to-day. And I am aware that there are a lot of people who say, don't look at a bar before it's closed. In other words, here we are in the middle of the month and we're looking at monthly bars. This bar that you're looking at here, this last bar, is the current month. We're roughly halfway through the month. This bar could look very, very different. We could potentially close up here. We could potentially close down here. Of course, we could be anywhere in the middle. Who knows? But the point of this is really to understand on this higher time frame, are we seeing something significant, something that matters? And I think the answer is yes, we are. Now, one easy measure, this is the full history of the S&P futures, because futures have some potential pricing issues. Let's look at the cash index. I think that's probably, for this type of longer term work, a little bit of a better guideline. And what I would like to point out is that on this monthly chart, we have engaged the lower channel for the first time since the 2008-2009 financial crisis. There have been other periods of market stress, of course. We all remember 2015. This is 2015. We all remember the two sell-offs in 2018, the second of which looked much worse than the first at the time. And none of those brought us to this level. Now, you might say, wait a minute, what is a Keltner channel? Like, it's just a line you draw on a chart. It is a line we draw on a chart, but it is a line that automatically adjusts for the volatility of the market. So it's a very consistent and reliable way for us to say, this is a big move, this is not a big move. And that's what I'm saying here, is that this move currently is a large move. It is an outsized move, especially considering the move's only halfway done. Let's look, while I continue to talk, I'm just going to flip through some other world markets. Here's a broad European index. And, you know, to be clear, it's not, with some of these indexes, like we've never seen this before, because we have in some regions seen similar volatility. Here's Europe. In the S&P, we really haven't. And I think that we are on the edge of what we have experienced. I think we are probably on the edge of what is knowable with these markets. And here's Japan. The future holds a lot more uncertainty. And I think what we can say about this is that the future is likely to be volatile. That's one of the things that, and when I say the future, I mean, let's say the next 2 quarters. Now, as I thought this weekend about how to frame this for you, I'm going to flip to a little bit shorter time frame chart. I don't talk a lot in these videos I do about my emotions. And that certainly is, for those of us as rational as we want to be. When we interact with the market, we are, of course, emotional. Markets are emotional. Traders are emotional. Investors are emotional. It's part of who we are and part of how we make decisions. And I also work pretty hard to be apolitical, to back politics out of this as much as possible. Here's a 5-minute chart of the S&P, and you can see the close on Friday. Let's open this up a little bit more. As I thought about this over the weekend, to be perfectly honest, I became angry with what we saw at the end of the day Friday, because I think it was clearly an effort at market manipulation. This was nothing more than President Trump, or the U.S. government, if you will, attempting to mark the book at the end of the week and engineer a weekly bar that was not a disaster. And they were successful. If you look at this weekly bar, the S&P, a real smart trader emailed me over the weekend and said, what do you think about that long shadow on the weekly bar? And if you just take this weekly bar at face value, this looks like a week that made a pretty good recovery. We had price rejection down there. We had a test and there was no price acceptance. What it actually is clear manipulation. And add to this that, of course, the market opens Sunday night. Most of you are aware. This looks very strange, right? What this is the market locked limit down. The market opened Sunday night with news that the Fed is basically going to do everything they can possibly do or should do to support the stock market, and the market responds by locking limit down. Now, that is extremely unexpected, to say the least. And what's going on here? Okay, here, and I apologize for the ramble, but 5 minutes into the video, here we get to what I think the future holds. So as I said, more volatility. I think the market is selling off because this is not a financial crisis. This is a health and psychology, human herd behavior crisis. Whatever you think about the facts behind the health crisis, and frankly, I tend to think that we're maybe not over-exaggerating. I'm quite concerned. It's just my personal opinion, and I certainly know people who understand more about epidemics and virology who are saying that we are overreacting. I don't know. Wherever you fall in that spectrum, I think you can make a good argument, and I think you could create some intelligent argument and defend your case. But that's not the point. The point is that the market is responding to this health stress, to the possibility of this becoming so much more significant. We're intervening with financial means, but it's not the nature of the crisis. Therefore, the market is just shrugging off intervention. The market does not care. And that's unusual, folks. Historically, as I've said before, intervention usually works. So to see intervention, at least, and it's early, we're only a few hours into the trading session, things could change, but to see intervention be so hopelessly ignored by the market, I would take as a very negative sign. It's because the intervention is not really addressing the problem. So the market weakness, here's point one. The market weakness is going to continue until we see an inflection in the health crisis, until we see something that begins to bend those curves in regions like Italy. Spain is probably going to be a hot spot. The UK is a region that we are all watching with great concern because nothing is being done there. US is taking pretty significant steps, and we'll know over the next few weeks, we'll know whether this is something that fades into memory or whether it's something that fades from memory or whether it's something that continues for many weeks, many months with a large toll on the human population around the globe. I don't know what the future holds there, but until we have some answers from that, until we see those curves begin to bend, I think market weakness is going to continue. That's point one. Point two is where the market is when that happens matters a lot. And that's going to make the difference between, do we need a bigger bear market? Do we, a bear market is part of the natural market cycle. It has the effect of a forest fire, cleaning everything out, clearing out, all the underbrush, all the dead stuff. And of course, that is a scarring and horrific and painful experience. And many things are destroyed in a forest fire, but it's part of what keeps an ecosystem going. It's the way the market works. This is reality. So the question is, will we be down enough that type of secular bear emerges? And one of the things that you do need to consider, how far could we go from the highs? Nobody really knows. I said in a tweet that I think we could be looking at a 60% haircut. It could be more. What if we start a major bear market from a point of 40% from highs? That's never happened in history. It certainly could happen here. So that's point one is, I think market weakness will continue until we see some actual impact on the health numbers that can begin to allay some fears there. Point two is where the market is at that time will determine whether we're looking at a much more serious bear market from that point, or a quick recovery. And I guess the corollary of point 2 is that if I had 30 seconds to tell somebody something important about stock trading, the most important thing you need to know is that it does not pay in the long run to bet against stocks. Stock markets can recover from hits that you would think would knock them out. Historically, this has happened over and over again. People who bet against bulls in stock markets are destroyed with stunning regularity. So therefore, you cannot rule out the scenario where something happens and the health situation resolves and markets scream back to all-time highs. I think that is unlikely. But so, I don't want you to get the idea, oh, Adam is forecasting a huge bear market that will trim 80% of value from stocks. Adam is saying that's a possibility, but it's not a foregone conclusion. And this is going to be some treacherous waters to navigate, but we will get through them. We will, the interesting thing is, for those of you who've been following my work for a while, you see the tools we use have led us through this recent crisis with a pretty good degree of reliability. The patterns have continue to be effective, and we understand how markets deal with stress, and we understand that there are limits to what are predictable. And we have a pretty good idea where those limits are. So we'll continue to use these tools, and I'm extremely confident that we will find the way forward here. But just, I guess, buckle down, batten the hatches, whatever you want to say, and prepare for a period of some more turbulence. Let's take a look at some other assets here. Crude oil continues to suffer from extreme pressure, and even more so in distillates. The crack spread has imploded. This has put pressure. There are, of course, companies. We should not assume that low oil prices are bad for oil companies, right? There are companies for whom low oil prices could actually be a boon. Imagine refiners who buy crude oil and make it into other things. Well, the problem is that even in this period of very cheap crude oil, the crack spread, which is their profit basically, has just absolutely melted. And this has been very bad for these companies too. So energy stocks continue to suffer. You tell I'm out of words, right? I don't really know what to say. Gold has been quite interesting because it has not acted right. We have seen gold is basically when they have sold stocks, they sell gold and silver too. Silver even more than gold. These are acting as risk assets, not as safe haven stores of value. So I guess a word of warning with that. And last, we've seen some pretty significant distortions in bond funds, and I'd be quite concerned with these. I know that some of you have significant allocations. I don't have specific wisdom here, but I do think there could be some internal problems. The valuation in these is always a little bit sketchy. To use a technical term, nobody really knows what the NAV of some of these things are at any point in time, and there could be more issues here. However, treasuries are resilient, and we actually see long setups here in treasuries that seem to be playing out. So we'll see, we'll see where this ends up. And of course, a lot more action here at the open on the short end of the curve, but we'll see as far as volatility, but we'll see where this ends up.